Hey everyone, welcome back. Nobody wants to get audited by the IRS, but the good news is that audit rates are actually pretty low. Less than 1% of individual returns gets examined, but certain things on your tax return can definitely increase your odds. Today I'm going to cover the red flags that are most likely to trigger an audit. First, high income. The more you make, the more likely you are to be audited. So if you're earning over $1 million a year, your audit risk jumps significantly. The IRS figures there's more potential tax revenue to recover from high earners, so they focus resources there. Second, unreported income. The IRS gets copies of your W-2s, 1099s, and other income documents. Their computers then match those against what you report. If there's a mismatch, say you forgot about a 1099 from a side gig, that's an easy audit trigger. Third, large charitable deductions. Charitable giving is great and the deduction is legitimate. But if your donations are unusually high compared to your income, the IRS will definitely take a closer look. Make sure you have documentation for every donation, especially non-cash contributions. Fourth, the home office deduction. Now this is a valid deduction for self-employed people, but it's been abused over the years, so the IRS pays attention. Make sure your home office is truly used exclusively and regularly for business. Fifth, business losses year after year. If you're reporting losses on a Schedule C for multiple years in a row, the IRS may question whether you have a legitimate business or if it's just a hobby. Hobbies don't get to deduct losses. 6, round numbers everywhere. If every line on your return is a nice round number, exactly $5,000 in travel, exactly $3,000 in supplies, it looks like you're estimating instead of using actual records. Real expenses rarely come out to perfectly round numbers. 7th, cash-heavy businesses. If you run a business that deals primarily in cash, restaurants, salons, retail, the IRS knows there's more opportunity for underreporting. They audit these businesses at a higher rate. 8, foreign accounts and assets. If you have money overseas and fail to report it properly, that's a major red flag. The IRS has gotten very aggressive about foreign account compliance. The best way to avoid an audit is to report your income accurately, keep really good records, and avoid aggressive positions you can't support. So if you're worried about something on your return, talk to your tax advisor before you file. Thanks for watching.